You know the feeling, right? You did all the hard work, your analysis was spot on, and your trade is finally in the green. And then it starts. That little voice in your head whispering, take the profit. Get out now before it's gone. So you do. You cash out, lock in a small win, and breathe a huge sigh of relief. But then you watch in absolute agony as the stock you just sold keeps climbing and climbing. That small win suddenly feels like a soul-crushing loss. What if you could finally shut that voice up? There is. It's a powerful, century-old rule from the legendary trader Jesse Livermore, and it's designed to do one thing: help you catch those massive, career-defining wins. And here's the crazy part, it's the one rule most traders still ignore. If you've spent any time studying market history, you know the name Jesse Livermore. It's usually whispered with a mix of awe and respect. They called him the Boy Plunger and the Great Bear of Wall Street. This was a guy who could conjure and lose fortunes. He famously shorted the 1929 market crash and walked away with over $100 million, which is like making billions in today's money. But his real genius wasn't just predicting the crash. Look, lots of traders can be right about which way the market is headed. They can nail the entry point. But where almost everyone falls apart, and where Livermore became a legend, was in what he did next. He mastered the single hardest part of trading: holding on. He admitted it himself, and this is the key to everything. He said, "It was never my thinking that made the big money for me. It always was my sitting." Just let that sink in. Not the buying. Not the selling. The sitting. The sheer patience to stay with a winning trade long after every bone in your body is screaming at you to run. Livermore knew this was rare. He said, "Men who can both be right and sit tight are uncommon." And right there in that one sentence is the difference between pocket change and a fortune. So let's break down the art of sitting tight and figure out how to use this forgotten rule today. Now, Livermore wasn't born with this wisdom. It was beaten into him by spectacular failure. Back in the late 1800s, he got his start in bucket shops, which were basically gambling parlors for stocks. You weren't really buying anything, you were just betting on price ticks. In that world, his strategy was perfect. He was a scalper, jumping in and out for tiny, rapid-fire profits. And he was so good at it, he literally got banned for winning too much. So, he takes his act to the big leagues, the New York Stock Exchange, and tries the same scalping strategy. It was a disaster. He failed miserably. On the real exchange, commissions, delays, and spreads ate him alive. He went broke. Multiple times. But it was from the ashes of those failures that he had his big aha moment. He realized the real money wasn't in the frantic, tiny wiggles. The real money was in the huge, sweeping trends. The major up and down moves that last for weeks or months. And to catch one of those monsters, you can't be hopping in and out like a nervous rabbit. You have to plant your flag, and you have to sit. This is where his discipline became legendary. He learned to hold winning trades for weeks, sometimes months. He'd sit through terrifying rallies against his short positions, watching his profits vanish on paper, because he trusted his read on the bigger trend. The trend was his friend, and everything else was just noise. As he put it, don't worry about catching the first eighth or the last eighth of a move. Trying to time the exact top and bottom is a fool's game. The real money, the fat part of the profit, is in the middle. And the only way you get that is with patience. So, what does this rule actually look like in practice? It's a simple, two-part command. First, buy right. Then, sit tight. Buying right was crucial. Livermore didn't just guess. He waited for the market itself to prove him right. For him, that often meant buying a stock as it broke out to new highs with real power. He wanted to see the market vote in his favor before he bet big. He'd even start with a small test position. If that initial trade worked, if the market agreed with him, only then would he add more money to it. It's a method called pyramiding, building on strength. But it's the second part of the rule where nearly everyone messes up. Sit tight. Once you're in a winning trade that's working, your job changes. You're no longer the analyst, you're the security guard. Your only job is to be patient. Because big trends are messy. They have pullbacks and scary dips designed specifically to shake out the weak hands. The market will do everything it can to make you panic and abandon ship. Livermore's rule is a declaration of war on that panic. It's the understanding that once a major trend is in motion, the odds are it will continue. Your job is to fight the urge to meddle. Let your winner run. Okay, that's the theory. Sounds great, but how do we apply a 100-year-old rule to the crazy markets of today? We can translate Livermore's philosophy with a few powerful, modern tools. First, use a simple trend filter. Livermore read the tape to feel the market's momentum. We can just look at a chart. Use something like the 50-day or 200-day moving average. The rule is dead simple. Why would you let 1 or 2 scary red days shake you out of a trade that's still comfortably above its long-term trend line? That line is your anchor. It helps you ignore the noise. Second, use a trailing stop loss. This is the perfect mechanical version of Livermore's rule. Instead of picking a random profit target that limits your upside, a trailing stop protects your gains while letting the trade run. For example, you might decide to sell only if a stock closes 10% below its highest price, or if it breaks a key moving average. This automates the exit. It takes you the fearful, emotional you out of the equation. You're no longer agonizing, should I sell? The market has to prove the trend is over before it stops you out. Third, learn to pyramid the right way. This one is non-negotiable. Livermore said averaging down on a losing trade was a mortal sin. You never add money to a loser. You only ever add to your winners. After your first position is profitable, you wait for the next confirmation, a new breakout, a successful retest, and then you add a little more. You're pressing your bets on your best ideas, not throwing good money after bad. And finally, and this might be the hardest part, trade less. Livermore believed you only get a handful of truly great, easy-to-spot opportunities each year. The rest of the time? The smart money is on the sidelines. In cash. Waiting. Patiently. Overtrading is the enemy of sitting tight, it's a disease of impatience. When you boil it all down, Livermore's rule isn't a trading strategy. It's a psychological one. It's a battle against yourself. He knew the biggest threat to your account isn't some hedge fund or a market maker. It's the person staring back at you in the mirror. Fear, hope, greed, and impatience. Those are the 4 horsemen of your trading apocalypse. Come on, be honest. Haven't you caught yourself clinging to a losing trade, just hoping it will turn around, while you cut your winners at the first sign of trouble? We all have. It's human nature. We're wired to avoid pain, a realized loss, and seek pleasure, a quick profit. Livermore's genius was flipping this on its head. He was ruthless about cutting his losses. A trade that went against him was a clear sign his judgment was wrong. He got out. No drama, no emotion. But a trade that went for him? That was the signal to do the hardest thing in all of trading, absolutely nothing. That constant itch to be doing something is a huge leak in most trading accounts. It comes from our need to feel in control. But here's the paradox, real control in trading comes from giving it up. It comes from trusting your homework and letting the market do the heavy lifting for you. You have to conquer that impulse to meddle. You have to learn to literally sit on your hands. If this sounds painfully familiar, if you're just sick of leaving all that money on the table, then commit to this. On your very next winning trade, make a plan not just for getting in, but for how you're going to sit tight. And hey, if this deep dive into trading psychology hit home, subscribe for more timeless ideas to sharpen your game. And I really want to hear from you. Drop a comment below with a story about a time you sold a winner way too early. We've all done it, let's learn from it together. Look, Livermore's life ended tragically, largely because he eventually broke his own risk management rules. But the power of his core idea, how to ride the big trends, is as true today as it was 100 years ago. Becoming a great trader isn't about finding some secret indicator. It's about mastering yourself. Imagine the trader you could be, someone who enters a trade with quiet confidence. Who sees a pullback not as a reason to panic, but as the normal rhythm of a healthy trend. Someone who isn't glued to the screen, sweating every tick, because they have a plan and they trust it. That is the person who catches the 100%, 200%, even 500% moves that everyone else just dreams about. It all comes back to that one powerful idea. It was never my thinking that made the big money for me. It was always my sitting. Learn to buy right. And then, have the courage to sit tight,